Did you know the investments on Shark Tank Pakistan could have a surprising twist when it comes to taxes? Startups that wowed us with their pitches on Shark Tank Pakistan are now under the spotlight, but not for their ideas. The FBR is scrutinizing their tax affairs, and the details might surprise you. Welcome to today's deep dive into the startup world. We'll unravel the FBR's investigation into Shark Tank Pakistan startups, explore what's taxable and what's not, and share insights every entrepreneur needs to know. Stick around for 2 actionable takeaways that could save you a fortune. The Federal Board of Revenue has flagged startups featured on Shark Tank Pakistan, questioning discrepancies in financial reporting and tax filings. But here's where it gets tricky. Capital raised during the show isn't taxable as income in Pakistan. Startups often showcase marketing numbers to attract investors, prepared differently from accounting or tax records. What looks like profit might not align with taxable income. Tax law considers specific adjustments, making this distinction critical for every entrepreneur. Finding this helpful? Hit the like button and share it with fellow entrepreneurs who could benefit from this knowledge. 1. Money raised on Shark Tank is considered a capital receipt and isn't taxable. Make sure your tax filings reflect this correctly. 2. Understand that marketing numbers differ from taxable profits due to varied preparation methods. Always work with an experienced tax advisor to avoid surprises. Thank you for watching Tax Dosti YouTube channel. Tax laws can be confusing, but they don't have to be a roadblock. Subscribe to our channel for more tips on navigating the business landscape, and let us know in the comments. What's your biggest startup challenge?